Hello, everyone. Welcome into Above My Pay Grade. My name is Eric. Thanks for tuning in. Don't forget to hit the like, subscribe, share this out. Really helps out the channel. Military just received their biggest pay raise in 20 years. Or did they? That's the real question. 4.6%. 4.6% pay raise to the military. Obviously, recruiting's been in the toilet. And I've talked about that here on this channel, but 4.6%. Will that help out with recruiting? And the real question is, was it a pay raise? The answer is no, because was it lower than inflation? If it's not, if it's actually a pay cut, 3% roughly, if it's lower than inflation. So let's take a look, and then I'm going to explain. If you stick around to the end, I'm going to explain why the military is never going to be able to keep up with inflation, with why and why we are in the place we're at today, and why I don't think this is going to change anytime soon. So if you're in the military, or if you have family in the military who think, hey, maybe a new administration, maybe something will change, yada yada, I don't think so. Not to piss in your Cheerios, but yeah, I don't think it's ending anytime soon. And spoiler alert, it's because of the national debt. So let's take a look at this story here from the Military Wallet. 2023 military pay charts. Military members will receive 4.6% pay increase in 2023, pending Biden's signature on the NDAA. Now, keep in mind, inflation in November was 7.1. We saw, I think, as high as 9 this year. So, in real terms, this is a pay cut. And in fact, in previous years, when you got a 2% raise or a 3, um, that was more of a raise. And I know that's hard for people to contemplate, but they're dealing with inflation. They know that it's stealing purchasing power. So, in real terms, this is actually more of a pay cut than it is a pay raise, and it's one of the biggest pay cuts the military has received in the last 20 years. Obviously, yes, it helps, but will that help enough? Yet to be determined. Obviously, everyone's situation is slightly different, and I don't know. Um, but my goal here is let you know if it doesn't keep up with inflation, it's actually a pay cut. So I wanted to show you why the military will never be able to keep up with inflation. Number one, we we are we don't keep up with inflation with military pay. It's based off the employment cost index, and that's another government-run number. And let's just say both inflation (CPI) and the ECI (Employment Cost Index) are, uh, if they lean any direction, it's in favor of the government paying people less. And the reason that is there's a lot of things that are indexed to inflation. One of them being Social Security and Medicare. And those are the biggest line items for the government when it comes to cost. So I did a video way back when about the chairman of the Joint Chiefs talking about how our national debt is the biggest threat to our national security. And this is when our national debt was 13 trillion. This was like a decade ago. So we've like tripled our national debt since then. So obviously the threat to our national security is even bigger. And taking it down to the bottom level, if you're in the military and you're not getting paid, would you do your job? The answer is probably no. So if we can't pay our soldiers, what happens to national security? And why we can't pay our soldiers is this right here. And I know there's a lot of people out there who are like, okay, numbers, who gives a crap? It matters a lot because this is what affects military readiness and pay and U.S. strength around the world. It all comes down to money, 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 money. And if you didn't know, there's a big reason why the U.S. military is so big, and that is the United States dollar being the world reserve currency. And we basically have contracts with other countries because we are their military because they use our dollar. And so military and military readiness and strategic wars fought and placement around the world when it comes to the military, a lot of it comes down to money, folks. So let's take a look at usdebtclock.org. Okay, a lot of this isn't totally up to date, but I want to point out a couple specific numbers. We're all familiar with the 31 trillion, right? So here's why the government can't pay you more. Okay, here's what they took in tax revenue, and that was last year. That was a record tax year. Why? Because you recall the stock market, the crypto market, and real estate were had record increases. So the government collects tax on that based off capital gains. So this debt to GDP number is basically how much we take in versus how much we're putting on the credit card. And you notice a pretty negative trend here. And so we get to this point where we have put things on a credit card by selling treasuries, and the cost of servicing those treasuries, meaning paying interest to people who buy our debt, is becoming very, very high. And if you look here, Medicare, Medicaid, Social Security, these line items are over $1 trillion, significantly over $1 trillion. And guess what these things are indexed to? Inflation. So inflation does not help the federal government lower its tax burden, lower its expenditures, because these two things, by law, mandatory spending, are indexed to inflation. So that leaves defense, which is discretionary spending. Yes, it went up to 850 million, but that was actually a pay cut for the defense budget, and we can argue about should it be cut or what. But adjusted for inflation, the Department of Defense got less money this year than it did last year. But here's the kicker. Here's a number that the U.S. doesn't really have a ton of control over, and that is the interest on debt. It is estimated that this will probably be over $1 trillion next year because a lot of the debt is getting refinanced. And we can go into that on a different video as to why, but a lot of this 31 trillion up here is getting refinanced, meaning our interest payment on it is going to go up. Just like if you were to refinance your house today, your interest on your house is going to go up because all interest rates are going up. What's the moral of the story, Eric? Why are you telling me all this? Well, I think you should cage your brain around the fact that this trend can't stop. They cannot pay the military more. And if they did, let's say that was priority number one, because recruiting was so bad that it was causing a national security issue, I think they would move to mandatory service. Maybe it's politically unpalatable, but maybe they'd move to mandatory service before they paid the military more, because they cannot, to put it very simply, afford it. They cannot afford it. And so the action they would take to pay the military more would make the inflation worse. So if you are in the military and you're thinking, one day we're going to go back to normal, we're not. When it comes to pay, we're not. And the reason this is in the last 2 years, we've had this debt for a long time, but we stepped on the accelerator to such an extent in the last 2 years that now there is no going back. There's no going back. And so we are fighting two wars right now, economic wars, inflation and recession, depression. And the government doesn't have a lot of tools to deal with that, believe it or not. They really don't. They're pretty much their only tool is to increase demand. And when you have inflation, but increase demand by printing money. When you have inflation, that's politically unpalatable. So, again, it's kind of sad. I mean, good news for some people, but yeah, it's not going to keep up with inflation. So I think over the next decade, you're going to see a little bit, 2% cut essentially in real wage gains, 1% cut in real wage gains over the next year. So that means lower standard of living for troops, and I think it's going to lower recruiting continuously. You guys let me know what you think in the comments below. See you guys in the next one. Peace.